Most risk assets in general generally do better in rising liquidity environments versus falling liquidity environments. That's not really rocket science. But Bitcoin, from what I've looked, is more correlated with liquidity than most other assets are, because other things that are more noise inducing, like things like earnings, or things being defensive assets, like perhaps gold, where you might go into it, ironically, on a lower liquidity environment compared to stocks. So Bitcoin, being both perceived as a risk-on asset with no earnings and finite supply, has historically, at least in the kind of the second half of its life cycle, where it's been big enough to be a macro asset, has been highly correlated with global liquidity.
Bitcoin continues to trade in the green zone as the maiden cryptocurrency endeavors to surge toward a new all-time high, bouncing back from the downturn experience in 2022. With a resurgence in value, Bitcoin is concurrently fostering an increase in millionaire holders. Specifically, as of November 12, the number of Bitcoin millionaires stood at 88,628, signifying a substantial increase of 60,544 from the 28,084 millionaires reported on January 5, according to data retrieved by Finbold. This surge in Bitcoin millionaires marks a threefold increase in 2023, equivalent to a remarkable 215% growth. According to Lyn Alden, Bitcoin was challenged during the low liquidity phase and doggedly survived, and now is thriving very well during the high liquidity phase, and this only goes as far as to show the superiority of Bitcoin to all other asset classes. Let us now get into the video as Lyn Alden discusses Bitcoin from a macro perspective and also discusses Bitcoin mining and how energy prices may affect them. As you watch, make sure to like, subscribe, and drop your comments below.
Few different models or correlations with what contributes to Bitcoin price action. And like you said, basically, in one sense, we want to make it so the price doesn't matter. But when you're doing a lot of CapEx, or when you're managing a portfolio, obviously price matters in various time frames, even if you don't really want to be a trader. And there's obviously been a lot of focus on the halving over time. So historically, halvings on the 4-year cycle, and the bull markets generally come after the halving. But there are some things that have historically been more correlated with Bitcoin price than the halving. And the one that kind of stands out from my research is global liquidity conditions, which is basically a fancy way of saying global broad money supply in dollar terms, right? So there's two main components of that. So there's one is how much money printing or bank lending is happening on a global basis, especially among the top 10 currencies or so. And then the second major factor there would be, is the dollar strengthening markedly compared to other major currencies. So generally, Bitcoin is challenged in a low liquidity environment and doing well in a high liquidity environment. And in terms of both correlation and causation, it makes sense, because as a finite supply money, you'd expect it to do pretty well when you have supply inflation of global currency, which is basically a predecessor to CPI and a more direct link to inflation than just the lagging effects of prices. And then in a correlate variable, so the challenge is that most risk assets in general generally do better in rising liquidity environments versus falling liquidity environments. That's not really rocket science. But Bitcoin, from what I've looked, is more correlated with liquidity than most other assets are, because other things that are more noise inducing, like things like earnings, or things being defensive assets, like perhaps gold, where you might go into it, ironically, on a lower liquidity environment compared to stocks. So Bitcoin, being both perceived as a risk-on asset with no earnings and finite supply, has historically, at least in the kind of the second half of its life cycle, where it's been big enough to be a macro asset, has been highly correlated with global liquidity. And I think that's one of the key things you have to look at going forward. And I think a lot of the metrics point towards kind of continued consolidation for a little while, at least in that liquidity indicator. And then as you look out a couple years, I would expect another sharply rising liquidity cycle, because it's only so long that you can maintain this sort of like poor liquidity environment before things break, things get rough, things decelerate, and then you have another round of higher liquidity.
Hut 8, a Nasdaq-listed Bitcoin mining company, announced it has received court approval to issue a stalking horse bid, a bid for a bankrupt firm or its assets that is arranged in advance of an auction to act as an effective reserve bid for a series of natural gas power plants and a Bitcoin mining site located in North Bay, Ontario. The acquisition, if completed, might end the legal battle between Hut 8 and Validus Power Corporation, Hut 8's power provider that was sued in January for failing to comply with a power purchase agreement, PPA, to supply 100 megawatts to Hut 8 facilities. If completed, the acquisition of a 40 megawatts facility in Kapuskasing, a 110 megawatts facility in Kingston, a 120 megawatts facility in Iroquois Falls, and a 40 megawatts facility in Bitcoin mine in North Bay would greatly enhance Hut 8's capacity for building self-sufficient Bitcoin facilities, without having to depend on other companies to provide the power needed to run them. Lyn Alden shares her view on energy and how it affects Bitcoin mining and miners.
Oil is fairly fungible around the world unless it's uniquely isolated. It's fairly lower cost to transport it compared to get out of the ground. Whereas natural gas, because it's a lot more costly to transport, you either need a pipeline or liquid cooling for long distances. That makes, the European gas market and the North American gas market can be completely different, like zip codes in terms of price, because there's a limited capacity to arbitrage that gap. And so given the lack of export capacity you had, North American, gas is kind of low. I think the next few months, it's really unclear because we have, kind of still decelerating economic indicators. Well, I think a lot of people overstate how much, say, oil is likely to suffer if we do get an outright recession. And that's because they kind of think back to the last two recessions. It's always recency bias. So 2020, obviously, oil went negative in some, futures and things like that because that was the biggest ever oil drop demand ever because it was a unique situation, not a normal recession. And then the one before that was the Great Recession. So one of the largest ever drawdowns in energy usage. Whereas when you look back over the past 50 plus years, there's only been like 5 years where global energy demand has diminished in any way. 3 of those years were in the early 1980s, right after the Volcker spike and the big dollar run that eventually led to the Plaza Accord. And then the other 2 were 2009 and 2020. When you look at recessions like the dot-com recession and other kind of more mild recessions, which again you shouldn't judge just by the equity market, but the actual indicators of the recession, oil is usually kind of choppy, weak for a little bit, and then recovers. And when we look at the tightness in the oil market, when we look at just overall energy kind of constraints, we already see kind of U.S. shale drilling is sort of the leading indicators are not constructive for like a continued growth and rapid supply. I would generally take the over on energy in most cases. I'm going to fade generally, whenever it has a bull run, people start kind of like, thinking it's going to go up to 120 right away. I generally fade those types of calls, but I think it's going to be stickier to the upside. And so I would generally keep taking the over on energy prices on a global basis, unless you can find very specific areas where it's stranded. There's other constraints involved, and there's all these unintuitive things. Like you can have Europe with an energy crisis at one point, and then everybody floods the market with it, and then energy prices collapse. So you get these weird gyrations, but I'm going to keep leaning into the kind of the view that energy prices are sticky.
Moody's recently downgraded the U.S. credit rating outlook to negative from stable. This has led to speculation that Bitcoin could be a haven asset for investors looking to hedge against the potential risks of a weakening U.S. economy. Moody's Investor Service has indicated a potential downgrade of the U.S. top credit rating. The downgrade is attributed to large fiscal deficits, a decline in debt affordability, and continued political polarization within the U.S. Congress. While the U.S. still maintains an AAA rating for the moment, the credit rating agency's downgrade reflects a growing concern about the U.S. government's debt and its inability to handle fiscal responsibilities. Without measures to cut spending or increase revenue, Moody's warns fiscal deficits could persist at a substantial level. This would significantly undermine debt affordability, especially in the face of rising interest rates. Moody's decision comes after Fitch Ratings, considered one of the 3 most significant rating agencies in the world, the others being Moody's and Standard & Poor's, downgraded the country's sovereign rating in August after months of political tension surrounding the U.S. debt ceiling. The downgrade shifted the U.S. out of the category of nations with the highest credit ratings evaluated by Fitch, one of 3 firms assessing governments and companies' ability to meet their financial obligations. Moody's Senior Vice President William Foster mentioned that any substantial policy response to address the declining fiscal strength is unlikely to occur until 2025. This delay is attributed to the constraints imposed by the political calendar in the upcoming year. Moody's decision to revise the U.S. credit outlook also coincides with heightened fiscal scrutiny, given the escalating national debt levels and political disagreements obstructing agreement on budgetary management. This has sparked speculation that Bitcoin could serve as a haven asset for investors seeking to hedge against potential risks associated with a weakening U.S. economy. Despite Bitcoin's price volatility, its appeal lies in its decentralized nature and limited supply, making it an attractive investment choice for those seeking portfolio diversification and a hedge against inflation and other economic risks. Do you own any Bitcoin yet? If not, what are you waiting for? Let's hear your thoughts in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.